and welcome to the latest news update on Canary News. China's central bank, facing multiple challenges, is employing unexpected policy actions to maximize their impact and stabilize the struggling economy. The People's Bank of China recently announced a record reduction in a key lending rate, marking yet another surprising move under Governor Pan Gongsheng's tenure since last summer. This decision follows a notable cut to bank's reserve requirement ratio, which caught markets off guard during a press briefing last month. These maneuvers illustrate the PBOC's efforts to bolster support for the economy while maintaining a cautious approach to stimulus. However, the central bank's ability to act is limited by concerns over currency depreciation, potential debt accumulation, and preserving policy flexibility for future challenges, such as deflation and a prolonged property downturn. Analysts speculate that the PBOC's strategy of unexpected policy announcements aims to garner attention and influence market sentiment effectively. Despite these efforts, the impact on markets has been short-lived, with modest gains observed in indices like the CSI 300 index and fluctuations in the yuan's value. While bond yields have declined amid expectations of further easing measures, some investors remain skeptical about the effectiveness of these policies in addressing broader economic challenges. The narrowing spread between short-term and long-term bond yields reflects growing pessimism about China's growth prospects. Although Governor Pan appears more willing to enact significant policy shifts compared to his predecessor, the PBOC remains cautious due to its institutional constraints and accountability to China's cabinet, the State Council. Critics warn that relying on surprise policy moves could undermine transparency and consistency in the central bank's communication with the market. Furthermore, when the PBOC fails to meet market expectations, it risks exacerbating negative investor sentiment. The recent decision not to cut interest rates in January, contrary to market anticipation, illustrates this challenge. While markets appreciate policy moves that exceed expectations, disappointing actions without clear explanations may lead investors to assume the worst, adding to volatility and uncertainty in China's financial markets. In other macroeconomy news, Goldman Sachs economists have revised their outlook on when the Federal Reserve will initiate interest rate cuts, now targeting June based on recent central bank statements and minutes from its January meeting. The investment bank has shifted its prediction from a previously anticipated May cut and now expects 4 reductions throughout the year, down from the initial forecast of 5. These adjustments, outlined in a note dated February 22nd, by economists including Jan Hatzius, anticipate rate cuts in June, July, September, and December. The forecast for next year also includes 4 additional cuts, compared to the previous projection of 3, with the terminal rate remaining unchanged at 3.5%. Despite expectations from investors and some economists for rate cuts as early as the Fed's March meeting, 3 key Fed officials emphasized on Thursday that any cuts are not imminent, though still anticipated this year. Hatzius and the Goldman economists point to 2 key shifts in the Fed's perspective. First, with robust economic data, officials are less concerned about maintaining rates at elevated levels for extended periods and perceive reduced risks from previous rate hikes, indicating that rate cuts are not an immediate necessity. Secondly, Fed officials are awaiting more conclusive evidence of inflation nearing the 2% target before considering cuts, as some fear that the economy's strong performance may impede progress in achieving inflation reduction goals. That is all the time we have for today. Tune in again next week for the latest news on Canary News. Remember to smash the like button and subscribe to our channel. This will allow our videos to reach a wider audience. Thank you for watching.